The core problem we're tackling today is pretty clear. How do you build resilience against unpredictable tariff costs? How can companies actually protect themselves?
Some companies are already using vertical integration.
Which basically means taking more direct control over your supply chain, maybe bringing production closer to home or even doing it all yourself in-house. How can vertical integration work as a shield against these tariff risks? We'll pull out the key insights and look at a compelling real-world example.
Welcome to Logistics Pulse, sponsored by Mothership. Skip the broker to save big on LTL shipments, or deliver same day nationwide. For more insights like these, don't forget to subscribe to Logistics Pulse on YouTube, Spotify, or wherever you get your podcasts.
Let's start with the challenge itself. Trade tensions seem to be ramping up, making U.S. tariffs particularly, unpredictable.
Oh, absolutely. Higher import prices and this general cloud of trade uncertainty, they're linked to broader economic forecasts.
Like what?
Well, OECD projections, for instance,
Yeah.
they see U.S. GDP growth possibly slowing down to maybe 1.5% in 2026, and inflation potentially climbing to 3.9% by late 2025.
And trade uncertainty is part of that picture.
So it's not just hitting individual companies, it's influencing the whole economic outlook.
That sets the stage.
Right. Vertical integration changes the underlying structure of how you operate by moving production maybe closer to where you sell, or even bringing it completely in-house.
You cut down your reliance on those imports.
Exactly. You reduce your dependence on suppliers located in those countries that are being hit hard by tariffs. Agreements can play a huge role here. They're not just about lowering barriers in general. They can actively support this kind of strategic move. Spotlight on the USMCA, the United States-Mexico-Canada Agreement.
Right, the successor to NAFTA. How does the USMCA help you avoid U.S. tariffs if you're, say, bringing production into North America?
Well, the key benefit is this. Goods that are actually manufactured within the USMCA region, so in the US, Canada, or Mexico, can often be exempt from US tariffs when they cross borders within that zone.
Okay, but there's usually a catch, isn't there?
There is. They have to meet what are called rules of origin.
Ah, the fine print. Rules of origin. What does that mean practically?
It basically means a certain chunk of the product's value, or the materials used, or the manufacturing steps must actually originate from within those three USMCA countries.
So you can't just do minimal assembly in Mexico with Chinese parts and call it North American.
Precisely. There are specific thresholds. But if you meet those rules, your product gets that North American status and can move between the countries, generally free under the agreement.
Got it. So if you shift your manufacturing to Canada, for example, and ensure enough of the product's content is from North America, you could ship it to the U.S. without facing those big tariffs you might have faced if it came from, say, China.
That's the strategic advantage. It offers this regional, potentially more stable alternative compared to relying on complex global supply chains that might be heavily exposed to tariff volatility, especially those centered in regions currently facing high U.S. tariffs.
Canada Goose provides a really interesting case study of a company that seems to have done this very effectively.
Yes, their story is a central example. Canada Goose manufactures a really significant chunk of its products, 75% right there in Canada.
And since Canada is part of USMCA.
Exactly. That high level of Canadian production is key. It likely allows their goods to meet those crucial USMCA rules of origin.
Meaning?
Meaning, when those Canadian-made jackets are imported into the U.S., they're exempt from U.S. tariffs.
And did it work? What did the company say?
It definitely seems to have worked for this specific issue. On their May 21, 2025 earnings call, Canada Goose apparently reported that tariffs had only a minimal impact on their business.
Minimal impact. That's huge when you consider the scale.
It really is. Something like $34 billion in costs and lost sales faced collectively by other firms due to tariffs.
And it sounds like owning their own production facilities gave them other advantages too, beyond just dodging tariffs.
Oh, yeah. Clearly, operational benefits. When you control your own factories, you gain a lot more flexibility. You can adjust your production levels up or down much more quickly to match what's actually happening with demand.
Which is super important right now.
Incredibly important. Being able to react quickly, not being tied to an external supplier's lead times or capacity, that's a major plus.
That kind of agility must be valuable. And the market seemed to agree.
It seems so. Their stock price reportedly jumped nearly 30% after that earnings announcement.
Suggests investors liked what they saw.
Yeah, confidence that their model had this built-in resilience, at least against tariffs, in a pretty choppy environment. But add this nuance, it's not a magic bullet for everything. Even though they managed the tariff situation well, Canada Goose apparently still decided to withhold their financial forecast for fiscal 2026.
Why would they do that if tariffs weren't the problem?
They cited reasons like jittery consumers and just the overall unpredictable trade environment. So the takeaway is, while their vertical integration strategy was a great hedge against the specific risk of tariffs,
It doesn't make them immune to everything else.
exactly. It doesn't shield them from a broader economic slowdown or shifts in consumer confidence or other kinds of market volatility.
So how does a company figure out if it's the right move for them?
Essentially, a series of steps or questions you need to work through.
What's step one?
First, you absolutely have to quantify your tariff exposure, map out your supply chain, figure out what percentage of your costs comes from regions that are currently subject to high tariffs or might be in the future.
Know the scale of the problem.
Exactly. The source uses an example. Say 40% of your input costs are tied to imports from China, and those face a 25% tariff. That's potentially a 10% hit to your total costs right there, assuming you can't just pass it all on. You need that baseline number.
Makes sense. Know your exposure. What's next?
Evaluate USMCA eligibility. Could your product realistically meet those rules of origin we talked about?
Like the percentage of North American content.
Right. For apparel, a 62.5% regional content rule is an example.
Yeah.
If your product today heavily relies on components or manufacturing steps from outside North America, hitting that target might require huge changes, or it might just not be feasible for your specific product.
Okay, and then comes the big one, the cost of actually doing it.
Estimating the capital and operating costs. This is the core investment decision. What would it really cost to build or buy a factory in the US, Canada, or Mexico? What about hiring people, training them, the ongoing running costs?
You have to weigh that against the savings.
Exactly. That upfront investment, a $100 million factory over 10 years, against the potential savings from avoided tariffs, plus any other benefits you anticipate.
And you also have to think about customers in the market, right?
Definitely. Modeling consumer and market impacts. If you can avoid tariff-driven price increases, could that help you maintain more stable pricing for your customers? Could it protect your market share if competitors are forced to raise prices?
And finally, look beyond just the dollars and cents.
Yes, assess the strategic benefits. What are the less tangible advantages? Maybe better quality control, because you own the process, potentially getting products to market faster, reducing your reliance on suppliers who might be unreliable or in volatile regions, and that flexibility we saw with Canada Goose, being able to adjust production quickly.
It sounds like a really involved calculation, more than just plugging numbers into a spreadsheet.
It absolutely is. Running different what-if scenarios. What if tariffs go even higher? What if they suddenly disappear? What if consumer demand tanks? How does your investment look under those different potential futures? You need to stress test the decision.
Okay, so let's say a company goes through all that, does the analysis, and decides, yes, vertical integration makes sense for us. What are the practical steps for actually making it happen?
The kind of phased approach, which seems sensible. First step, a really thorough supply chain audit.
Map everything out again.
Map it all out, pinpointing exactly where those tariff risks are and where the USMCA opportunities might lie. And, crucially, get experts involved early, especially for navigating those complex rules of origin. You really don't want to get those wrong.
No kidding. What's step two?
Pilot regional production. Don't necessarily jump in feet first. Start smaller. Maybe move one product line, or just part of the production for one line, to a USMCA location. Test the waters, see how it works operationally, check your assumptions.
Like Canada Goose starting with core outerwear in Canada.
Learn from that pilot. Then, if it looks promising, step 3 is investing in the actual infrastructure.
Building or buying facilities.
Right. In the USMCA region, maybe close to your key markets. Also, look into potential local incentives, like tax breaks governments might offer to attract manufacturing.
Makes sense. Get the building, then you need the people.
Develop your workforce capabilities. That means hiring and, importantly, training employees. You might need skills in advanced manufacturing, and you need a strong focus on quality shows. Canada Goose's skilled Canadian workforce is part of their premium brand image.
And technology has to play a role.
Oh, definitely. Integrate technology. Use things like automation where it makes sense, IoT for tracking materials and processes, data analytics for efficiency and planning. And finally, step 6. It's not a one-and-done thing.
You have to keep watching it.
Monitor and iterate. Keep a close eye on tariff policies. They can change. Watch market conditions. Be ready to adjust your strategy. And track your progress using clear metrics, key performance indicators, or KPIs.
Like?
Like actual tariff cost savings you're achieving, or changes in how long it takes to get products made and delivered. Things that tell you if the strategy is actually delivering the benefits you expected. The downsides are real.
Such as?
Well, the huge upfront capital cost, obviously. The potential for it to become a distraction, pulling management focus away from the core business. And the fact that once you own factories, you're now directly exposed to local issues, labor relations, regulations, things like that in your new locations.
And critically, this strategy just won't fit every industry.
That's a key nuance. Think about high-tech sectors like semiconductors. Their supply chains are incredibly complex, incredibly globalized. Trying to significantly regionalize that kind of production might be astronomically expensive or just technically impossible right now.
The main takeaway from this really seems to be that vertical integration can be a genuinely strong defense against tariff volatility, especially if you're a company with significant exposure to international trade. It could actually become a real competitive edge.
A way to differentiate yourself in a turbulent market.
It really makes you think, though. What other kinds of shocks or disruptions might companies be unintentionally buffering themselves against? Could gaining that operational control provide a broader resilience than just against tariffs, maybe without companies even fully realizing it at first?
For more insights like these, don't forget to subscribe to Logistics Pulse on YouTube, Spotify, or wherever you get your podcasts.